A big welcome to all our Twitter viewers. Thank you very much for joining us here. We announce a partnership with Motilal Oswal Asset Management as part of the investor education initiatives of the fund, along with the Money Mile, to bring to you great minds, great voices across the spectrum to educate you on how to invest. Today with me is Aashish Somaiyaa, who's the MD and CEO at Motilal Oswal Asset Management. A very strong voice here on Twitter. His tweets are amazing. I thoroughly enjoy them, and so do you, all of you who follow him. He's joining me here today to discuss what we can do in today's market. Markets have been volatile. We had a dream run in 2017. 2018 hasn't been that great. While at the large cap index level, we may be okay, but at the mid cap side, we've had quite a beating from the kind of levels we saw back in 2017. So the obvious question is fear overcoming? Is it what is driving my investments at this point? Am I holding back on my SIPs? These are all questions that are being asked today. So we thought it's best to get Aashish to talk to all of you and to guide you through. Aashish, your philosophy, which is buy right, sit tight. In today's market, are you getting good buying opportunities? Are your fund managers able to pick up good stories even at the current state? And then how do you keep sitting tight when you see around you stock prices going down the way they have?
So barring few exceptions, we don't actually see too many churn or too many movements in and out of our portfolio. So generally speaking, we've held kind of steady. The only thing which I can see in the last year or so is that in 2017, everybody was very, very concerned about where valuations were, although the past return looked very, very good. Whereas actually, if you see in 2018, we are holding on to pretty much similar portfolios, not too much churn. There is 1 year of earnings which has gone by, but on the other hand, a lot of stock prices are down by about 15-20%, and in certain cases, maybe much more. So clearly, if you ask me from here on in the next 3-4 months, if things remain like this, you will eventually see value emerge, and that will definitely give opportunities to a lot of us.
What are the kind of expectations? You think it's time to relook at expectations which investors had, because we were looking at 15%, 17% is a good return to have. Do you see those driving the fact that now I'm in negative and, I thought I'm going to get a smooth 15% every year?
So a couple of things on expectations. I think one is that, we've seen from January, February onwards, specifically after budget, you're seeing a lot of mid caps, the mid cap index down by about 15-20%, small cap index similar or actually worse off. But you have to keep in mind that in 2017, the very same indices were up 48% and 57% respectively. So from that level, if you see a 15-20% slide back, then that is not totally unusual. And talking of expectations, I think it's not just investors. I think my industry, we all are part of the problem. I think even we need to set the kind of right expectations. So from that perspective, I would just like to say that investors need to maintain perspective. One perspective I already shared. What happened last year and why what is happening now is not that unusual. In fact, I write to investors pretty much every month, every alternate month, and somewhere in January, we actually wrote to investors that it's time to check your expectations, and if you think you made more money than what you thought, then it might make sense to take some money out. Obviously, this is not broadcast in a public manner, but it is written to our investors. Like we have, say, about 900,000 investors in mutual funds and another few in the portfolio management services. So we wrote to all of them. So we need to set right expectations, and investors ideally should not assess us for any 6 month or any 1 year. I mean, hopefully investors also would assess us for more like, review us for more like a 3 year, 5 year or a slightly longish performance track.
A lot of people did SIPs in the last couple of years, and I think a large part of your growth has also, come in the last year, year and a half. You're one of the fastest growing AMCs today. What has been the behavior pattern so far that you're observing? Are people getting panicky in the market like this? Are they stopping their SIPs or re-looking at it? What is the experience that you're getting on the ground?
So I don't see any early signs of turbulence as of yet. I mean, last 3-4 months, the market has been on a decline, but I think the overall industry as well as our own book, we are seeing the SIP kind of increasing every month, and we are not seeing any kind of breakages or cancellations really. Talking of SIPs, I think, people should keep in mind, investors should keep in mind it's that precisely for this kind of day. And if you're in Bombay, then precisely for a rainy day is why you had actually done your SIP.
Right.
In fact, your SIP was counterproductive last year because every month you were averaging up. Whereas this is the year when your SIP actually starts doing the role, playing the role for which you did SIP in the first place. So I hope people, I don't see any early signs of trouble. People are not reacting, and I hope that they remain steadfast.
You're a pure play equity house in that sense. Would you tell a person that you have no option, you have to have some amount of your assets in equity? Is that a view you hold? And because if you really want to beat inflation, you want to build wealth, a lot of the questions we get these days are from young people, Aashish, who are looking to invest either for their retirement or for their children.
Yeah.
So you're talking of a 15, 20, 25-year time horizon. I hope they stick to it, because sometimes, we all say that I'm going to invest for this long. But at least if you remember earlier, when people said long term, it was 1 year, 1.5 years. At least now people are saying my long term horizon is 20 years, 30 years, 40 years. Now with that kind of a change and shift in attitude, do you think that with that time frame, equity becomes the best bet?
Yeah, I think people have always been saying that they invest for long term, but the moment there is a 10% downdraft, then the definition kind of just goes out of the window and we start assessing our portfolios. So clearly that perspective has to be kept in mind that, over the next 10 years, 15 years, if somebody guides me that I should get 10-12% CAGR in the equity and maybe a good fund should outperform, then we should be very clear that we have to first of all stick to the time horizon which we indicated. And second of all, assess people over a particular time horizon rather than every 3 months or 6 months. And the third thing is that whatever the return you are anticipating is not going to be straight line. It's not like 10, 10, 10, 10 and 10. It will be minus 20 and plus 25 and minus 7 and plus 4, all those kind of numbers. So we have to stay through all of that. And I think investors need to have that perspective in mind, that they don't shift the goalpost just because the market is doing something crazy.
We recently saw a very big change, Aashish, in the industry, right? With the reclassification of the schemes, etc., etc. Now, while changing the name is one thing, but there is a whole shift underlying there, right, which is happening. Can you explain that to viewers? Should they worry about it? What's happened to some of the schemes they've invested in? What about past track record now? Is it a completely new scheme? What's been your experience on that front?
So I think the good parts of it are easier stated. The good part of this is that it puts the whole industry on a level playing field. Okay, for example, we used to run a mid-cap fund which we launched in 2014, and we had a difficult time in the last couple of years because initially we started off, but then last 2 years was difficult for us because our mid-cap approval said that stock number 101 to 200, 75% of the portfolio. Rest of the industry was running a mid-cap fund which was pretty much laissez-faire. They could do what they wanted because they were launched 15 years back, 20 years back when the definitions were not so stringent. Now what the regulation says that a mid-cap fund is stock number 101 to 250 and 65% of the portfolio. Now you can imagine what kind of difference it makes to people like us, because we were really, really hamstrung and now we are on par with the industry. So I've just used my fund as an example. But the fact is that it now enables apples and apples comparison. In the past, we were comparing wrong things. That's the best part of it. Second, it makes the choices of funds a bit straitjacketed. So investors can decide that, okay, these are all mid-cap funds. I need to pick 2 of them. This is a mid-cap fund. I need to pick 2 of them, and they're done. Previously, it was very confusing for people to be able to pick. So these are the good parts of the regulation. The negative part of the fallout is that any which way when this regulation got into implementation, there was a bit of a meltdown in the small cap market and a bit of changes in the macros. Now, as a result, what has happened? As a result of the regulation, what has happened is that my sense out of the 8 lakh crores of equity assets, roughly 7.25 to 7.5 lakh crores has been pushed into top 250 stocks by market cap. And it has left a big vacuum in what is the so-called small and mid cap space. Because as per this regulation, mid cap ends at about 11,000 crores. Between 10 to 11,000 crore mid cap ends. Below that, everything is small cap. So that definitely creates a vacuum. We don't have prevalence of small cap funds. Barring 2 or 3, I can't think of many. So the whole industry's money has been pushed into top 250 stocks, and that presents a different set of challenges as far as delivering performance is concerned and generating alpha is concerned. So I think that, it will put a kind of lid in terms of the capacity that a fund can manage. That's a good fallout and a not so great fallout because it impacts scalability of products, but on the other hand, it enables fair measurement.
So there was a question which we got earlier that, do you intend to start a small cap fund as well? Is that something on the cards?
Not immediately. I mean, at some point in time, we may. I don't want to say that we will never do it. I don't see us doing it immediately, anytime in the future. The reason is near future. The reason being that there are scalability challenges. Number one. Number two, small cap funds have this weird thing about having very lumpy returns. So in a year like 2017, you will show 50-60% return. Then you're really putting yourself into trouble because based on that return, you might get inflows, and then from there on, you might have really bad performance. So in the portfolio management side of the business, we do have some small cap portfolio. But when it comes to a mass retail product like a mutual fund, it needs scalability, it needs a bit less volatility. So we don't see us doing a small cap mutual fund immediately. At some point in time, we might think of it.
What about the mid cap space? Is that something that still excites you?
I think mid cap, personally, I mean, there are many experts out there. Everybody has a different view. But if you ask me personally, it's my favorite space. Because let's leave the labels aside. But just look at it this way, that if you have $2 to $4 billion, according to me, is a sweet spot. And we've done some analysis on this in the past. If you forget the return and the label, just break it into probabilities. You take large cap, you take mid cap, you take small cap. And then you do 5-year time buckets, that how many companies traverse from being small cap to mid cap, how many companies traverse from being mid cap to large cap, and how many companies remain large cap and deliver a return in any 5-year time frame. What you will find is that large cap companies have a high probability of remaining large cap, but the return is not that great. Small cap companies have a higher average return, but the probability that a small cap will become mid cap is barely 2-3%. And the probability that a small cap will traverse to being large cap in 5 years is next to nothing. The best risk return combination is always in this $2 to $4 billion kind of market cap. And in India, it's interesting because there are a lot of sector leaders who happen to be, or till recently were actually in that bucket itself. And there will be more and more of them. So I think that's the best space to be in.
There's a question that we've got from one of the viewers who says, please do ask Aashish what went wrong with Manpasand beverages. So I don't know. I don't want to normally talk about a specific company, but
no, of course we should. We are answerable. So in fact, we say that we have a certain philosophy or a certain investing strategy where we look for quality and growth. And if you see, for example, this India has a different trend. Typically people love Coke and Pepsi and those kind of aerated drinks, but India has a different trend where fruity drinks are. So all said and done, I think in terms of the business case and in terms of the potential for the company, I think all the homework, I think that was probably in place. What has happened obviously is that there is some discord between the management and the auditor has quit. Now clearly when the auditor quits without explanation, then definitely there must be something missing. And we wrote to all our investors and channel partners that clearly in this maybe something we have missed out. We've done all our homework, even we do test checks, we do groundwork. But clearly if the auditor resigns and there is a discord with the management, then there is something which we have missed out. Now let's see where we are. There is a new auditor in place, 7-8 weeks have passed, they declared the results. And they declared results which were probably, the market is still doubting those results, and rightly so. There is a doubt which has been created. If you see from our perspective, we admitted that maybe we missed out something in there, and there are learnings for us. Because however well you may execute your investing philosophy, when you own 20, 25, 30 stocks in your portfolio, there is a scope that somewhere or the other something you would miss out, because every investment is a hypothesis that you are making, right? Now, of course, a lot of water under the bridge, the company has declared results, the market is still, doubting it. We ourselves are kind of in a review mode because we have to see how things play out. There's a lot of price damage already done, so there was no point in us acting after the price damage is done. So we are watching. Clearly there are learnings for us, there is no doubt about it. Just two things I would like to add. One is that, it was considering it's a small cap stock, we had 1.7% exposure. So fortunately for us, the damage was kind of limited. The other thing to keep in mind is that, when our investors feel the pain or there is something that is happening, it hurts us as much and probably more. Because what is lesser known is that we back it by our own huge skin in the game and our own investment. So definitely you can blame us for something having got missed out in the process, but in terms of implementing it better, in terms of having the heart in the right place, in terms of being aligned with investor interest, I think we are there.
It's been wonderful talking to you, Aashish. Thank you very much. And look forward to many more conversations here on Twitter Live. Thanks for watching, and please do send us your questions if you have any. We will have Aashish answering them as we go along in the next days and weeks and months to come. Thank you very much for tuning in.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.